Welcome to the Main Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main. He is president of Main Financial Group, as well as joined by Adam Freund, CRC, Certified Retirement Counselor with Main Financial Group. To our viewers at home, we have a very special show today. We're going to talk about retirement roulette. Well, what does that mean? Is that a new game that's happening in Las Vegas? No. This is all about the stock market, and we're going to talk about, should your risk tolerance change? Should you be using any risk at all whatsoever when you're in the retirement years? We're going to find out today on this show. Jordan, how are you?
Oh, great. I'm happy to be here for another day of fun. How are you?
I'm fantastic. Thank you so much for being here, and thank you for asking me to be here with you. I'm looking forward to today's show. And Adam, how are you?
I am fabulous. Would you expect anything different? Come on now.
I would expect nothing less from you, because you are always happy. And I have an important question.
Sure.
So with where you're from in Michigan,
yes,
what does it mean when Michiganers say up north?
Sure. So, I mean, I know that you don't live in Michigan. Mm-hmm. You're down in North Carolina.
I am.
We have something very unusual for our state, because I think we're the only state that can really do this. Is anytime someone says, "Where are you from?" we always lift up our hand and we point, "Oh, we're right from here." Now, when someone from down here says they're going up north is, we never really kind of figured out what line that was, but usually up north is over here. Right? Wouldn't you say that?
Well, interesting. I grew up in the middle of Michigan.
Show them on your hand.
Oh, on my hand. Yeah, right here. Currently, we live in Metro Detroit, so anything north of really an hour away is up north. But where I grew up in a little small town, Midland, Michigan, up north was the Upper Peninsula, which you'd go over the Mackinac Bridge. So depending on where you are in Michigan, the version of up north is different.
Right, but we always think of the Upper Peninsula as the UP.
That's so cool. So where did the hand come in?
Our state looks like the mitten.
So everyone does that?
Yeah.
Anyone in Michigan that I would ask, where you? Oh, that's so amazing. Yeah. Let's talk about that today instead of the actual topic. Definitely. That's really cool. So I want to talk a little bit, obviously, this is about the stock market and how much risk someone should have when they are entering their retirement years. And Jordan, I want to ask you a question. People are curious about the idea, of course, of retirement roulette. You have something that's an acronym that you like to use in the office, the entire team. What is that acronym and what does it mean?
Yeah, we use this cute acronym of LIST, L-I-S-T, and these are what we think of as eroding factors in retirement, things that can derail your retirement. The L stands for longevity.
Okay.
What if I screw up and live too long? What if I outlive my money? What if I live to be near 100 and have long-term care issues? The I stands for inflation. And maybe 20 years ago, right, Adam, it wasn't as important, but boy, the last several years, inflation has dramatically impacted people's retirement.
Yep.
Yes.
The S is what we're going to talk about today, stock market. What version of risk is comfortable for you? And in my opinion, it has nothing to do with your age. It is whatever risk tolerance you can tolerate.
Okay.
And then the T in LIST stands for taxation. So today we'll focus on the S, the stock market, and how to manage that through retirement.
Okay, that sounds perfect. And I know I'm going to be going off topic just a little bit. So you said age is not correlated with risk. So that kind of takes away the rule of 100, I'm assuming.
Absolutely. The rule of 100, for those of you who don't know, was traditionally you take 100 minus your age, and that should be your balance of equities to bonds or fixed vehicles. But what we found as people are living longer, everyone has their own level of risk tolerance. And we use the analogy of driving a car miles per hour. And if someone wants to drive a car 80 miles an hour, that means they like a lot of risk, and they should take more risk in their portfolio. On the flip side, if you only like to drive 25 or on the side streets, you should probably have a little less risk in your portfolio. So we have a separate website.
Yeah, that website is mfgrisktest.com. mfgrisktest.com. It's free to anybody to use. You can take it 100 times if you really want to, but it's going to give you a good idea as to where you are on that risk level. And I think we go from 1, which we've never seen, to 99. which we've never seen.
And it's just an 11-question survey, and
Yeah.
it will give you a score of what your individual risk tolerance is. So, and everyone, and the three of us at this table would have totally unique scores.
Yeah.
Sure, I'm sure. So, Adam, obviously we know there's always some risk with the stock market, of course, but why should someone's perspective change in retirement?
Yeah, well, I mean, essentially, there's a accumulation phase, right? The time that you start really working in the economy, and it's all of your working years. That's the accumulation phase. But then we have to transition over into a distribution phase, and that really starts to work with not only your risk test, but what your goals, your wants, your needs are in retirement, and make sure that we're crafting a plan that fits that. There is a need for risk in retirement, but that distribution phase becomes way more important, especially after you stop working.
Yeah, I use the mountain climbing example. Think of that, Cynthia, as your life cycle in finances is like climbing a mountain.
Okay.
The way up is the accumulation years that Adam talked about. You're working. As you get towards the top of the mountain and you're now in the clouds, you're getting close to retirement. We call it our retirement red zone. And you have all these different buckets of money and choices to make, Social Security, Medicare, all these things. But getting down the mountain is the distribution phases, which is retirement. And would you believe that 94% of all deaths in real mountain climbing happen on the way down?
Way down.
Because
wow.
people use the same, or try to use the same principles and fundamentals on the way down as they did on the way up. And all your strategies have to change when we get to that distribution phase.
Yeah, you can't use the same principles that you were using while you were accumulation. Time is on your side. You're 40 years old and there's a stock market crash. It's not really going to affect you. In fact, if anything, you're put more money in. You're buying everything on sale.
We call that what? Dollar cost averaging.
Dollar cost averaging. What happens after retirement?
That's right. If the market goes down and you have to take money to live out of that account, it's called reverse dollar cost averaging, because now you're taking dollars out of an account that's depressed in value. You're exponentially will be depleting your accounts.
Wow, that's scary. Very, very scary.
Very scary. Now, we do look at risk, or that portion of your portfolio, the growth portion of your portfolio, to cover things like inflation. We want to make sure that we're staying ahead of that, and we also call that section your playcheck.
Okay.
Right? That's the money that you have to take the vacations, to buy a new car, give the grandchildren gifts. But we really want to focus also on paychecks.
Yes, and so I have to ask you, how do we get growth? Because we need growth, so how do we do it?
Absolutely. In growth, you have to take on risk. And so the more risk you take on, the more growth you can get. But the more risk you take on, you can also bring in losses. And that's why in retirement, it's very important to understand your own tolerance for risk.
Yes.
We have a nearly 90-year-old client, single, Marjorie. We'll say that's not a real name for confidentiality,
Yes,
but we'll say Marjorie, never married, no children, no beneficiaries, and on a scale of 1 to 100, she drives nearly a 90. She likes to go to the casino once a week, and she takes a lot of risk because she can tolerate that. On the flip side, we have a young man in his early 30s who inherited a trust from granddad's farm. And he has everything in a protected, fixed, no-risk type of plan, which conventional wisdom would say, you're younger, you can take a little more risk on. He can tolerate a very low level. So it is really unique to every individual client.
And that's why it's so important to do something like this.
Absolutely.
Right? So this is the main money report. I'm sure some of you that have tuned in before know all about this, but it's highly customized to your risks, to what your wants and needs are. This is not something that just happens in one appointment. It's a 2-appointment process. Jordan knows a lot about that because we do it all the time in our office. But the first appointment is really to get to know you. And Jordan always likes to say, this is a good MRI, good MRI of what it is. You go to the doctor, you have an issue, you do all the workup, you meet with the the physician's assistant.
Yes.
Maybe that's me.
Yeah, right.
Or our colleague Brandon, who you've also seen on this show before. You meet with the physician's assistant, and then the doctor comes in and gives you prognosis. But that's not usually on the same...
I need a white coat.
Yeah, you do need a white coat. That's not on the same visit. So we come up with this. It is highly customized. This is not something that you're going to just order or get for free. You really have to come in face-to-face, sit down, talk with us. We'll get you one of these reports. It's completely complimentary, but it will take 2 visits.
Let's do it now, shall we?
Sure.
All right. To our viewers at home, we know you're in the viewing audience and you're asking yourself, how do I get my very own customized Maine Money Report? Well, this is your opportunity. You have to call into the number 888-462-7839. This is completely complimentary, no obligation, but this basically will be a deep dive into your retirement planning process. Are you on the right road for retirement? If not, wouldn't you want to know today? This is your opportunity. Have one of these beautiful reports custom designed for you, no cost. 888-462-7839. We're going to take a very short commercial break. Don't go anywhere. We're going to talk about sectors when we return.
I was an accountant by trade out of school, out of Michigan State, and I absolutely hated brokers, financial advisors, whatever they wanted to call themselves. I was a tax accountant, and we would share a mutual client. And this broker would advise our mutual client to buy, sell, and never do any tax strategy, and I was left to clean up the mess. So I went to the client and said, please talk to your broker and tell him to knock this off or begin to do some strategy. And the typical broker response was, I'm not licensed to do that. I can't talk about taxes. So I basically decided to get my investment securities license and all my other licenses out of spite so that we could do all the tax planning as part of the investment strategy for our clients. The value of choice, as we always say, if you go to a big box firm, they're going to have one of 6 portfolios, let's say, and you're going to fit into one of those. The value of working with an independent advisor, especially a fiduciary like we are, is that they have to do what's in your best interest, and they can use any program that's licensed out there in America, so a huge difference. After 20 plus years on this side of the fence, I think our industry does a poor job at explaining to the public the difference of those two. I come from a culture of helping people and educating them, not just telling them what to do. So I think people that truly want to educate make a big difference in this industry.
Welcome back to the Maine Money Show. My name is Cynthia DeFazio, joined today by Jordan Maine. He is president of Maine Financial Group, as well as joined by Adam Freund. He is CRC, Certified Retirement Counselor at the Maine Financial Group. And we're talking all about the stock market today, specifically talking about your risk tolerance and what that means to you in retirement. And gentlemen, I know that I mentioned that we were going to talk about sectors in segment 2, but I was kind of hoping that we could segue back just a little bit, because I think we just started uncovering the different types of risk. So Jordan, let's talk a little bit about risk in retirement, especially with the stock market. What about emotional investing?
Well, that's something we see all the time. They always say buy low, sell high, right?
Yes.
People seem to do the opposite of that. When things are good and the stock market is up and people have confidence, they want to buy then.
Yes.
And then when we see turmoil, which we've seen over the years in many different areas, COVID and back to the bank crisis, people want to sell when it's crashing. So that's buying high and selling low. And that never seems to work for long-term strategies. Sticking to fundamentals is so important.
Yeah, and trying to time the market.
Yes.
It drives me nuts when people, when we meet with people and they say, well, I try to time the market. When is the best time to buy? When is the best time to sell? Well, there's a whole lot of things.
Did you bring your crystal ball?
Yeah, let's see. I don't have one here, but wait a minute. Now, no. The issue is that we're seeing so much volatility to try to time the market. Even the best managers out there, they don't time the market.
It's true.
They know that basically sticking in the market, sticking with it long term, it's going to grow over time. I can't guarantee that. We both can't guarantee that. But how do we know it's going to grow? Well, the stock market, despite what you might read in the news right now, is higher today than it was 10 years ago. And the stock market 10 years ago was higher than it was 20 years ago. So we know overall, if you stick to it, don't emotionally sell, don't emotionally buy.
True.
We're here to talk you off the ledge. And it's important to keep with the plan, stick with the plan.
Well, and I think that to follow up on that, I think it's important to have active management versus passive management. What is passive management? Think of, well, here in the Midwest, Cedar Point is a very popular place to go on roller coasters and things. Passive investment style is simply getting that ticket on a roller coaster and riding the ups and downs of the market. There aren't any strategic moves or downside hedging. It's just let it ride. And what I say when people come into us, new prospects or clients that come in, and we see how they're allocated, you don't have to look at your statements or even open them. You can just look at the TV. When the market's up, you're going to be up. When the market's down, you're going to be down. Yeah. So what we try to implement is active management. And that's when it gets us into our sector discussion that we alluded to earlier.
Yes.
There are about 11 sectors that the market follows and does projects on the CNBC and what have you.
Yep.
We condense it a little more. We put a few together. Like an example,
Okay.
we could put energy and utilities in the same sector, even though they're two different ones. And
Yeah, technology and communication, for some reason, especially Morningstar, likes to separate those two. But when we started looking at the reports more closely, we were noticing that Google and Facebook was in communication. Well, wait a minute. As far as I know, Google and Facebook are communication
tech company.
and are tech companies, and then even Amazon somehow throws itself all over the ring.
Interesting.
So when we're looking at those sectors, we're making sure that you're not overweighted.
yeah,
Some of the other ones?
Yeah, we've got healthcare as a sector. That's a popular one.
Okay.
You might know something about the real estate sector as well. That's
Yes.
a portfolio, the area that you can go into.
Okay.
Finance is a sector, and a lot of people think that just means banks, the financials they call it, but it's also insurance companies, mortgage companies,
Credit card companies.
credit card companies. That sector very sensitive to interest rate moves.
Okay.
And over the last few years, we've had a lot of those interest rate moves.
Absolutely.
We've got industrials, which are big, airplanes and transportation companies, and I think aerospace and
Defense.
defense,
Part
right.
of that.
We've got materials as a sector. Materials would be all the things, chemicals and construction materials and mining and packaging, things that go into maybe a different product that comes out.
Okay.
And then really we have our two consumer categories.
Yeah. Okay.
We have consumer staples and consumer discretionary. What's the difference? Consumer staples are things that we all need to buy, not really depending on our income. We have to eat, so we have personal care, we need basic transportation. The consumer discretionary are more the luxury items that are more dependent on our income. Hotels, restaurants, big luxury cars,
malls,
items, all those.
Things that go into shopping. And I'd like to tell you that we committed this completely to memory because all 11 sectors, but no, we wrote them down here.
I was going to say,
yeah.
amazing.
We have the sector spreadsheet. I think we're going to put it up on the screen here, and it shows you that all these different colors represents all the different categories. And if you notice, just looking at the colors, there's a different one that's the winner or the losers. And every year it's unique and different. So you can't just buy one or two sectors and ride the roller coaster.
Yes.
It is actively managing. And as an example, if you look at energy for the last 10 years has always been at the bottom of the barrel, with the exception of, was it 21 and 22? Both years returned over 50%.
Yep.
So here's one that has been just a poor performer for a decade, and in these two anomaly years, it goes to the top. And vice versa, on the flip side, technology for the last decade has always been in the top 3 or 4, with the exception of 22, where it lost, I think, about 30%. So it is so important to manage your sectors actively with the fiduciary investment advisor.
Yeah,
Absolutely.
and that's the whole part about actively managing a portfolio, right? Because we really don't know what sector is going to be number 1, what sector is going to be number 11, right?
True.
And the truth of the matter is, you probably should be in all of them, just different levels, right? And it's adjusted, being tactical, looking to the future, and making those adjustments as it comes.
We spend a lot of time looking at leading and lagging economic indicators, and we look at our sector allocations. We've got a great partner. Charles Schwab is our custodian, so they have a lot of resources for us as well. So I can't tell you how important it is to have active management with your sectors.
And it's so important for our clients at home to have one of these, the Maine Money Report. To our viewers at home, this is the perfect time for us to take a commercial break. As you can see from today's show, this information that we're sharing with you is so crucial for your retirement years. Don't you deserve to have the Maine Money Report? Well, we think you do. All you have to do is call in one time, 888-462-7839. Book your time accordingly. Claim that spot. Let these gentlemen take a look at what your goals, your dreams, and your hopes are for retirement and design the Maine Money Report just for you. We're going to take a very short commercial break. Don't go anywhere. We're talking all about risk in the stock market during the retirement. We have so much more to get through when we return.
The culture at Maine Financial Group is, I think, in one word, family. We really enjoy working with each other. And yes, at times it can be hectic and chaotic and things are going at 100 miles an hour. But it's all done with the main goal in mind, and that is to make sure that all of our clients are treated with respect, have plans in place, and essentially are as happy as they want to be.
In this business, I'm a believer, if you do right by the client, you'll be rewarded. I think we work hard and we're a family. We really are. It's organized chaos in our office. We work well together, but it's orchestrated chaos, and there's a lot of love in our office.
It's important to enjoy what you do. And so we're a family, and we'll bicker, but we ultimately love each other, and we work hard together.
Welcome back to the Maine Money Show. My name is Cynthia DeFazio, joined today by Jordan Maine. He is president of Maine Financial Group, as well as Adam Freund, CRC, certified retirement counselor at Maine Financial Group. I stopped there for a second because I wanted to ask you one more thing before we go into our next topic that I think is so important to understand. Why is it so important to be diversified in the sectors that we just spoke of in the prior segment?
Well, we're talking about risk, right? So if we throw all our eggs in one basket, let's say we rode technology, right? Technology seems to always be hot, the NASDAQ, and all of a sudden a thing like 2022 happens, you lost 30% of your portfolio, boom, overnight.
Yes.
So to speak. That's putting all your eggs in one basket. You can't do that. You have to have a very diversified portfolio, something that is spreading among all the sectors, just to make sure that, again, we might all think that technology is going to be the next great thing, right? Bitcoin, whatever it is, social media.
Sure.
And we could be wrong. The next Bill Gates could invent something tomorrow that has anything to do with technology, and it's something to do with energy.
And I think within each sector, there's a subsector. Like you said, in technology, there's AI, there's robotics, there's autonomous vehicles, there's
electric vehicles.
There's electric vehicles. In the healthcare world, there's biotech and all kinds of unique things. So I think there are subsets within each sector as well. So you have to look at what you want your spread to be on a high level, and then deep dive into each individual sector. And that's why we're really not big fans of mutual funds because they have so many layers of expenses. We like ETFs, which are exchange traded funds. Tell them the difference.
Or straight stocks too. We like straight stocks. One of the biggest is again with mutual funds. Not only do they carry a cost with them,
or multiple costs,
layers of costs. They're also hard to get out of, meaning that if there's something going on in the market, you have to wait till the end of the day in order for you to get out of that mutual fund, because behind the scenes, they're doing all this buying and selling, buying and selling, buying and selling. They have to settle up at the end of the day, and therefore you could be in some real danger, shall we say?
If you have a volatile market,
if you have a volatile market,
a major announcement or something.
And
ETFs,
you're stuck waiting.
Oh yeah, you're stuck waiting.
Wow.
ETFs can be traded just like stocks. Exchange traded funds can be traded just like stocks. Instantaneously.
Wow.
So if something happens in the market and you want out, you can get out fairly quickly.
And the expense ratio on ETFs are essentially averaging under 10 basis points. That's like less than 10% of 1%, if that makes sense.
The accountant would say de minimis.
Oh, de minimis. That's a great word. I know.
I like that word. Well, obviously, let's talk a little bit about something so important, paycheck versus playcheck. We have about 3 minutes left, but let's jump into that, because what is that exactly?
Well, it's exactly what kind of it sounds like, right? We divide your portfolio. We try to make sure that you have a paycheck. A paycheck is so important when you're in retirement because that's the money that you're counting on that's going to be there every month to make sure that you're not going to sleep with one eye open trying to figure out where the bills are going to be paid from. We have to make sure that your retirement plan covers that part first. And you want to talk about the paychecks?
Yeah, well, exactly right. So the paychecks have to be a guaranteed source of income. You know, what maybe a pension you have, Social Security you have, any type of guaranteed income. The paychecks are dollars that are growth mode, but you can grab them as needed. So
Okay.
when it take the cruise or do something with the grandkids or what have you. But we shouldn't have to rely on the paychecks for our daily living. And I think that's a big mistake a lot of advisors and people do, is that they have one big risk-based equity account, and their market is going up and down, and when they need to take money out, what if we're in a 2022 where the market was down? That's going to exponentially deplete that. So take your paycheck money out when the market is growing.
Correct. You don't want to rely on that. Again, we see this with some of the big houses will do everything all in one bucket. Well, that's okay. You have stocks that produce dividends. You'll just use the dividends. And it's just, that's a bunch of hooey.
Well, and interestingly, when you talk about the ETFs, exchange traded fund, normally they just maybe like track an index. So what is an index? You know, everyone knows the general top three are the S&P 500, the Dow Jones, and the NASDAQ. Now they have, what is it, over 900?
Over 900 different indexes.
And there might even be more than that. That was from a while we looked into it. So you can get unique, specific indexes, like an index for robotics only, or an index for healthcare only. So there are a lot of things to choose when you look at your sectors.
Yep.
Most definitely. And Jordan, all of this information is just so important to know during the retirement years regarding investing. Any final words of wisdom you'd like to share with our viewers before we close?
Yeah, I think every successful financial plan has to have 5 key areas, really. And you have to have a guaranteed income plan. We've talked about that a lot. Not an income guess, an income plan, right?
Yes.
We've got to have an investment strategy. And that's what today's show was all about. We need to take consideration tax reduction in your retirement plan. We need to make sure we have, here it is, a plan for health care in retirement, social, Medicare and long-term care. And lastly, we need a good estate plan to make sure that everything's where it wants to go after you're gone.
Jordan, thank you so much. Adam, thank you so much. Subliminal pointing to the book, by the way, to the viewers at home. That number to call is 888-462-7839 for your customized Maine Money Report. Don't miss this opportunity. This is designed just for you. Be safe, be happy, and be blessed. We'll see you back 1 week from today on the Maine Money Show, where Wall Street meets Main Street. Take care.